Howdy, Jacob here. Today we're looking at Primoris Services Corporation, the construction engineering industry. 3.1 billion market cap on 3.7 billion enterprise value. Pretty impressive growth. 1 year of revenue decline in the last 10 years. Otherwise, they've been growing high single digit, low double digit. So very impressive. However, we are looking at a very low gross margin, about 10 to 11%, with an operating margin of about 4 to 5%. They do pay a dividend, but they haven't really increased it since 2018. Return on invested capital, 6 to 8%, mid to upper single digits. Not terribly impressive. Balance sheet has 218 million cash and cash equivalents, 73 million short-term debt, 885 million long-term debt. Looks like they made an acquisition or multiple acquisitions, net acquisitions 2021 and 2022, and they funded it mostly through debt, it looks like. But they did pay it down. It is declined from a year ago, so it looks like they did pay a little bit down. But majority of their cash flow, it's really all over the place pre these acquisitions, but recently those acquisitions are taking up an immense amount of free cash flow due to the fact that they're not making a huge amount of free cash flow, and they used a heavy amount of money to make these acquisitions. The dividend of $13 million in relation to their free cash flow recently is less than 10%, so not terribly worried about that. But with the debt that they have, if they can keep that $170 to $200 million, it's less than 5 times that. But we're just going to have to see where the free cash flow ends up peaking out at. But for now, not terribly concerned with the debt. It's more debt than I would like, but I'd be more concerned just that they go into debt to fund these large acquisitions. I think it's fine to fund acquisitions through a little bit of debt, but I do like organic use of free cash flow better. And so for me, I think I'm ready to make some assumptions here. Revenue growth side, they've been growing pretty heavily through acquisitions, and the amount of acquisitions, or the amount they've paid for acquisitions, has been so grand. They're using over 100% of free cash flow. I like to assume 100% use of free cash flow, so maybe 50+% goes to acquisitions. I think that's going to limit their growth to maybe 6% or so, with margins of 3 and 2.5%, with share change 1% is about 30 million. Let's just assume roughly flat. Terminal PE, let's try market average here. 6% growth is above market average, but organically probably going roughly in line with what the market is, or the average company in the market is. And we're saying it needs to fall a little bit more than half again. So right now, I don't think it's at an interesting enough price for me to do a deeper dive in. Hope you enjoy the video and have a great day.